Our next guest has more than $2 trillion in assets under management and is one of the region's biggest investors. Well, Rick Lacaille is Global Chief Investment Officer at State Street Global Investors. Rick, thank you so much for coming in. The picture is not much clearer than it was a couple of weeks ago. We still really don't know what the European leaders are thinking, whether they're talking about restructuring. Now there's this new word, reprofiling, which is just the extension of a debt. How much more difficult does it make your job until you actually see, well, this is what they want to do, and it's very clear for everyone that they intend to either restructure or not to restructure?
Yeah, well, we have an indirect exposure. Clearly, we're not, generally speaking, now exposed to Greek debt in many portfolios because they've left the benchmarks that our clients are following. And where we're active investors, there's enough uncertainty there that we're not taking a position on the long side, or at least we have not done in the recent past. But there is an indirect impact, and I think this talk about reprofiling is an interesting one because it will need to be reasonably aggressive to have a meaningful impact on the debt to GDP ratio. So simply shuffling around a few years and extending maturity a little may not be enough to prevent another restructuring or default a few years down the road.
But so that will impact presumably all of the European banks and European equities as well?
Well, they're affected to a different degree. I mean, European banks have different exposure to Greece, but keep in mind they've also got exposure to the rest of the periphery. So the reprofiling may allow them to keep their debt on the books at 100 cents in the dollar, and therefore apparently not need any more equity. But I think it's really quite clear that under Basel III, and perhaps from a prudent perspective, there is a need for more equity capital in European banks, and this is just one of the ingredients that leads you to that conclusion.
But at the same time, today Vodafone was saying that they're very cautious about Southern Europe because of their exposure to France and Italy, so it must also have an impact on how you see corporates that are exposed to these periphery countries.
Yeah, I think corporate exposure to periphery countries is not large from an economic and profitability perspective. If you look at companies like Vodafone or indeed any others, yes, they have an operation in the periphery, but in terms of the overall profitability of their business, it's a marginal impact, and I think investors shouldn't be as concerned about that as other issues, like how a company is going to maintain margins at a level that's been very high compared to history.
Rick, where do you see any bargains actually in peripheral? I mean, why not buy some, Portuguese bonds at the moment? They've just been given a bailout. Is there any kind of way of making, I talk about a quick buck, but maybe over, 2 or 3 month period?
Well, I think we have to be careful about these bailouts. When you have a bailout that simply involves overcoming a temporary liquidity problem, that's not the same as debt forgiveness or anything structural that will in effect get them off the hook. So I think investors still need to be wary about the periphery bonds, and certainly the more extreme periphery bonds, in terms of the potential for reprofiling. And frankly, there are a lot of other things that fixed income investors can do that don't involve taking this black or white bet on the periphery.
Like what?
I think corporate credit and high yield is still very interesting. I think the emerging market local currency bonds in many countries are very interesting because the underpinnings, the financial underpinnings of those countries are very, very different. They haven't been exposed to the same risks.
First of all, the debt ceiling in the United States has been breached. What does it mean? We've had very little reaction on the markets. We talk about sometimes these bond vigilantes that will do exactly the same thing that they've done here in Europe to the US. Is that likely?
I think we shouldn't get fixated with the debt ceiling. It's an arbitrary number, but really it's a recognition that Congress or the American political establishment cannot reach agreement on how to control the rising deficit. So we should be more concerned about the underpinnings of what's driving that deficit and what's going to start slowing it down. And at the moment there's no agreement. There's not enough pressure yet for an agreement. And that looming 11-week deadline, which has now been kicked onto 11 weeks, is really the deadline that I think bond market investors will be looking for. I don't think the bond vigilantes are going to be interested in whether there's an actual default at the end of that 11 weeks, more the political process from now and then.
And where do you stand on the gold debate? Would you buy some or would you sell it?
Well, we have gold as part of a more well-diversified commodity portfolio that we have an overweight in, or have had an overweight in, over the period where we've been risk on, so to speak. And the reason for that is, again, the precautionary principle. We see a lot of looseness in monetary policy. We see the potential for long-term inflation. Gold itself has a very emotional resonance with a number of people, and that's why you have this polarization. But I think we should step back from that and say, why are we interested in commodities at all? It's really to protect ourselves in the long term.
Yes, but protect ourselves if you think that there's no hard landing in China. Because if there is a hard landing in China, then commodities don't seem such a good bet. Are you confident that China's taking the adequate steps to actually cool down softly?
Well, I think we seem to swing in our attitude to China. Either they do everything right or
everything wrong.
or everything wrong. People worry about property bubble and so on and so forth. I think we should look for better signs that core inflation is under control. But nevertheless, there still seems to be a degree of momentum in the Chinese economy, which means at the moment we're not seeing a hard landing. But it is one of the risks we've outlined this year. We've outlined that risk, we've outlined margins declining in corporates. I think those are things that equity investors in particular need to be concerned about.
And actually on margins, Rick, this is your main concern, the fact that actually currency fluctuations, but also costs going up will mean the margins will continue being squeezed.
Well, yeah, step back a minute. Margins tend to mean revert in the very long term. They're at a very high level. So you think, what are the ingredients that could push them down? We see very sharply rising input prices, and yet we see an inability to pass those prices on to end consumers of product. Therefore, they'll be squeezed from that perspective. I think in some parts of the world, labour shortages are going to start squeezing margins as well.